Take a little breather, people, because we're just going to talk about trading today. There is no sales pitch, it's all just trading information. So if you've got Facebook up, if you've got your phone on, I would just say turn them off for a bit, because we're actually going to go through quite an interesting trade. Right, and the trade we're going to look at today is what appears to be quite a scary trade, and that's fading volume spikes, trading against fast one-way moves in the market. Now we're going to discuss what to look for, how to enter, and how to know if the trade is working or not. And in fact, we'll discuss various outcomes of this trade, because this isn't just a win or lose trade, it's actually a progression or a cascade of events in the market that occur one after the other. So we'll teach you how to identify each of those events. Now, to keep this simple, I'm going to talk mostly about moves down that turn back up, and just consider moves up that turn down to move in the same way. And that kind of saves me from stepping on my tongue too much when I say and the same for up. Now we'll look at why this trade works, how to recognize it, and how to manage a trade, and then we'll look at how to make it work for you, because whatever you do with trading, nobody's going to push the button for you. Now before we start, I would like to consider that what we're discussing here is a market behavior and just one way to trade that behavior. Now I'm not saying that my way is the best way, so you could find a better way at executing this trade than me. What is important is that you understand the behavior before you start throwing money at it, or even before you start sim trading it. Now, if you're not yet profitable and trying to make sense of trading, this is actually a really good place to start, because it requires no indicators, it requires no long-term analysis. It just takes a little bit of time to develop your skill trading this one series of events. Now, if you're skeptical about this, you can spend the next few days validating that what I'm saying is true, and that's all it will take for you to see. And after that, it's up to you if you want to pursue it. Now, you don't have to take anything on faith here, because you will see this playing out in the markets yourself if you look tomorrow. Now, how did I get into this trade personally? Well, as many of you know, because I've invited quite a few people that are here today, I like the mini S&P futures, right? And I've been watching that every day for over a decade. Now, the second half of this year has been very frustrating. It's been really slow. And for me, it's got past the point where I'm willing to spend too much more time at my trading desk watching the S&P do nothing. So I started looking for some other, kind of low maintenance trading opportunities to help me when the S&P is dull. And that's what this is. So if you're trading the S&P, interest rates, or any other market that has bored you a little bit this year, then this is absolutely something you should look at. Now, for those that are struggling, please understand this isn't something you can apply tomorrow. I understand people are keen. This is something you can apply in 2 or 3 weeks' time, right? There's some work for you to do between now and starting to trade this, right? You have to build some firm expectations as to how the market's going to play out in the market you choose. So it's not hard, just needs a little bit of discipline. So before we get into the trade, let's talk about what this isn't, right? Because this is not a trade that occurs in a predefined location. In other words, doing some kind of preparation before the market opens isn't really going to help you with this trading in any meaningful way. And that's worth noting, because lately I've seen a lot of trading plans that start off with some sort of weekly analysis and daily analysis, and then when you actually get to the trade, it says they've got a target of like 2 ticks. And if you're scalping for a couple of ticks, you should really be able to do that without the market reaching some kind of predetermined area you want to do business. You shouldn't need weekly charts for a 1-tick scalp. So there is a belief that all trades must take this kind of top-down approach to start from the outside, the longer term, and work your way into shorter-term analysis. It's to look at higher time frames and then lower time frames. Now, I'm not saying that's a bad thing to do. I'm not saying it's bad to do analysis before the day starts, to have some preconceived ideas of where the market might react. But it's not going to help you with this trade, and quite a lot of other kinds of trades that are out there. And this trade is going to yield a lot more than a few ticks, but it's still a short-term trade based on short-term activity. So we're not going to worry about trying to identify ahead of time where this will happen. And a lot of trades are like this, right? It doesn't make them worse or better or more or less reliable, just makes them a little bit different. So if you've got in your head that some kind of pre-market prep or homework is mandatory before you take a trade, then just open your mind a little bit as we progress. Now, saying that, there is going to be some homework required before you can make this work. So this trade works in a lot of markets: crude, DAX, natural gas, gold, heating oil, basically the more volatile markets. And in each of those markets works slightly differently. So your homework is research on how this behavior plays out in your chosen markets. And the key factors or differentiators are going to be, how often does it occur, times a day, times per hour, how often do you get false signals, how do you know it's a false signal, how much would you need to risk on that market, what's typical reward, what are the triggers for the trade, what's the state of the market it works best in, that kind of thing. Now these factors are going to be very similar across all of those thinner markets. So when you actually come to focus on one market, you're just looking for specific nuance. Like you can expect a higher frequency on DAX than you can on crude. So if you only have a couple of hours a day, DAX might be better. But then if those couple of hours are between 9 AM and 11 AM Eastern time, probably crude's a good market to trade. But before you take a single trade, you need to observe, take some notes, and just get to understand this behavior. And it's going to remove a lot of preconceived ideas that you might have in your head about how to trade it, how it works. And you might even find that on some markets you end up trading the failure of the behavior. Well, I've worked with a lot of traders that have gone through this observation process, and it's ended up changing a lot of their preconceived ideas that they have about specific behavior. So we'll talk a little bit more about this at the end. Now, I know that most people still have like the mind, just stop with all the crap, just tell me where to get in and where to get out. Now, if that's you and you've been at this for a year or 2 or 5 or 10, just consider the merits of a couple of weeks studying the behavior. Get to know it, then start trading it, not the other way around. Now, just confirm, guys, that you can actually see my chart here. It's the first one with the chart on it. Just make sure you're catching up with the slides. Bum, bum, bum. There you go. Thank you, Yves. Right. So the behavior that we're going to look at today is actually quite simple. And this is the why of the trade. And then we're going to look at the how. Now, at the risk of stating the obvious, a market moves down because lots of people are selling it, right? And on most days, the majority of trading we see is short-term speculation. We don't know the exact mix. So let's agree, there's always short-term and long-term players in the markets. Long-term players don't react to short-term price moves. So on a short-term basis, we know that like the future short-term moves, the most immediate short-term moves, are going to occur when short-term players react. So if it's only short-term players reacting to short-term moves, we can actually pretty much forget about the long-term players when considering how the market might react in the short term. Now, of course, the exception to that is on a news-driven one-way day with a lot of long-term positioning, but they are the exception, not the rule. But anyway, as the market moves down, the number of net short positions is going to increase. And in addition, the people willing to sell more also decreases. They've had their fill. They've reached their maximum position size. In other words, you've got more and more people that eventually need to buy to take a profit, right? All of these short positions here that build, they've all got to buy to make a profit. Very obvious so far. But there's a little bit more. You're a speculator, right? We're all speculators here, and as speculators, none of us care at all if the market we're trading is going up or down, right? We just want to be on the right side of it. We don't care long or short. So when you consider the other participants in the market you trade, it's also logical to assume that they're probably the same, that they don't really care if they're trading long or short side. They're just there to exploit the moves, okay? And I think that's a fair assumption to make. So what we want is for the market to get into a position where there's not many other people that want to sell, and that we've got a lot of short positions, and that will see people buying to unwind their positions, and that generally gives you a pop to the upside, okay? But what causes the market to really move is when the majority of speculators believe that the path of least resistance is now to the upside. So the profits are now to the upside, and that's where we get a trade continuation. So ideally what we're looking for is we want the market to pop to the upside after we get into a trade. And then we want to see signs that, speculators, the kind of more lazy traders, actually say, no, let's just go to the upside now, okay? And if we don't see either of those things, we don't have a trade. Now, so far, I obviously could have been talking about any reversal in the market. But what is unique with these volume spikes, you can see here, big spike down, high volume. is the reversal occurs after a sudden, fast move with lots of volume, as if the market got too excited and sold off a bit too hard. So we end up with a lot of traders potentially caught on the wrong side of the market. So let's look at this, how this appears in a real market, and walk through what's going on. So here's a couple of volume spikes here and here that contain the elements we're looking at. So for those that don't know the Jigsaw tools, just quickly, these circles show areas of excessive volume, so a lot of volume traded at price. Volume bars are below. These are price bars, obviously, red for when there's more sellers than buyers, and green for when there's more buyers than sellers in that period. This is actually an 8-second period, so what you're looking here at here is a very fast move down. So first we have a push down with excessive volume, and as we can see with their volume spike, it's quite an extended move. Now on the way down, we see a few areas where excessive volume traded, so here, here, and here. So what we're looking for is one of these volume areas to get run over, for the market to move up through their positions, and for us to get a small pop as those positions get stopped out. After that, we want to see some form of continuation. So in this first reversal, we've got traders, late sellers trapped here. Then we've got the pop up here. You can see this nice move here. And then we've got a little bit of consolidation, and it was a while before we got the continuation up. Okay. The next spike does something similar. We had a push up. Then we saw an area, just a little bit of an area of excessive volume. Market went sideways for a little bit, which time we had a few more positions building in that area, and eventually we see the stops trigger here, and the market saw then a continuation, a more orderly march downwards. Now note, we don't need to see this excessive volume here at the exact height of the move, right? These are kind of thinner, more slippery markets. So we just use these positions here as a line in the sand, and once the market actually moves through them, you know, from the upside here and the downside here, you know, we use these, it should trigger stops, and the market should stay this side of that volume. So what we're looking for initially is simple, an excessive move with a lot of volume, and then a cluster of volume to get stopped out. So that's the easy bit. The skill to develop is in identifying when the market is really set to stop these traders out, and when to get out of the way quickly when you're wrong, whether price moved against you or not. So let's look at the first trade. This is a fairly tame volume spike in gold. We can see market move down rapidly. We've got a lot more volume here than anywhere else after a period of moving sideways. We have one price here where we traded an excessive amount of volume. Now, like I say, this doesn't have to be one price. It could be several prices. What's important is you have a cluster, an area of high volume, an area with a lot of positions in it. Now, there was obviously some excitement on the way down. Very likely, people got positioned because they thought they were missing out. So as the market pushes up, those late traders are going to get nervous. And you know, we can see the volume traded at each price on the way down here was much higher on the sell side. You know, we can see all these red bars. And on the way up so far, it's actually mixed. You know, we've moved up a little bit, but it is moving up. If we look over on the tape here, it's actually quite mixed. So at this point, there's no real aggression. Market's actually moving up to this area of high volume. There's no aggression, so we don't really have anything to do at the moment. But when we do see something, we're not going to really care whether we actually take a long trade below the circle, at the circle, or above the circle. And we'll go into that a little bit more later. Okay, we moved on a little bit, and what we can now see, we can see we've got a flood of large buyers. Now, this screenshot really doesn't convey the speed and aggression at which they came in. The tape here is only showing the large trades, 10 lots of above, which is big for gold. And my take on this is actually now they're coming in, they're actually hitting this area of high volume, they're trying to run the market. And this is where a bit of skill comes in. Because if buyers are hitting the offers hard like this and getting price progression, which they are, it's very hard for the market to fall back in the short term. So I'm going to try and get in with a limit order here, as this is a fairly thin market. And as long as we see buyers participating, you know, I don't see this trade running against me. And that's basic tape reading, and one of the skills that's going to make or break the setup for you. So remember the bid here at 1282.0, because I missed the trade and didn't get filled. So buyers did come in aggressively, as we can see on the tape, and I didn't get in till 3 ticks higher, which is fine. Not great, but fine. So we saw, obviously after that, we saw a nice little push up here. As the short side speculators from this area, that's where they're getting stopped out. That's when you see that push up. And then we had a little pause, and the little pause is like your phase 2 for these trades. So we expect the pop from here because these traders get stopped out. So it's pretty clear where the late sellers are stuck down here because we've got all this volume, right? But once we've popped up, are the speculators overall now going to feel that the upside is just the more easy? So if we start to move sideways from here, it means there's no bias, there's no certainty. But if we continue to move up, it means that yes, in the short term, speculators think the upside is the path of least resistance. And that means the market has likely fully reversed now, and we're going to see some good continuation to the upside. So the pop is the stop out of the traders below, and the continuation is when the bulk of speculators feel that the upside is now the easy side. So you enter, you see the pop, and then you watch like a hawk for this continuation move. Okay? And this is where we got to. Now, when I showed that first volume spike, I actually said it was actually pretty tame for gold. And if you look back now, it does look pretty small on the volume chart. You know, on that first spike, we'd effectively broken out of a range and pushed down. In this case, what we have is a market that spiked up after an extended move. And that's often a much better trade because it's quite common for traders to get caught up in the excitement of a move. You know, we've all watched the market move up and up and up and up, and with each push up, it feels like we're really missing out until we can bear it no longer. We finally buy, and the market reverses and stops us out. Okay? So we know if this market starts pushing down now, the late buyers up here, these two circles here, are going to be feeling very nervous, as we all do when we buy at the top and it moves down. Then the earlier sellers, the guys that bought, the earlier buyers, the guys that are still holding from this move up, they're going to start to feel like, well, maybe it's time to take some profits. But make no mistake though, selling at this point is quite scary, especially if you didn't study this in advance. The market just put in a big fast move up, and selling big fast moves is not comfortable. So we do need some confirmation. Now if we look to the right, we can see some big sellers coming in and pushing the market down a bit. And that selling continued. Now it's worth noting here, this white area above is an area of high seller liquidity. Nothing to worry about. I certainly wouldn't put my stop against it, but it's kind of comforting to see that there. On the tape here, you know, we can see more sellers have come in, and we can see, you know, they're actually getting some move down for their money. The larger buyers here are just getting run over, which is kind of perfect. But not every trade works out, and it'd be dishonest of me to just show winning trades. So why do I have my stop order at this particular point here? Well, you can see here that buyers have taken control, and we're actually closing in on the highs. If we do move through this high, we're going to see some stops trigger without doubt. So what I'm doing here is I've got to stop here because I'm pretty sure it's over. I want to give it a bit of room, but none of this putting stops above the high, above the swing. That's almost guaranteeing slippage. So if this was going to be a winning trade, then the sellers would have already put their foot on the gas, and we'd have seen some buyers get stopped out. As it is, we didn't really get that initial pop, you know, that move when the stops get hit. So there's really no reason to stay in. Now the cool thing here is the risk-reward ratio. We got into a trade initially when that first momentum was on our side, and we're getting out because we lost that momentum, and there's a risk of a stop run against us. Now the market has actually moved against us 4 ticks, which is a beautiful stop for gold, and that's the beauty of trading these spikes. They're not as risky as they first appear, as long as you watch the order flow and get out if it doesn't generate the pop you expect, or you get out when it appears they just give up. So let's review this spike behavior. Now the stage most of you are at, almost certainly with this right now, is you've probably seen this happen many times. Maybe you've even been caught on the wrong side of a spike a number of times, buying the high or selling the low. You know, most likely you've stayed away from trading against spikes because you think it's a dangerous time to trade. So we have to tame the tiger. Look at the spike rationally and break down how the market behaves. So first, we have an aggressive, fast, extended move with lots of volume. Now these are all relative terms, and they relate to the behavior prior to that move on that day. So one day that could be a 200 tick break, another day a 30 tick break, just depending on overall volatility for the day. Then we need to see one or more prices with excessive volume close but not at the low of the most recent push down. So an area with a lot of volume over a narrow range of prices. And that is our tipping point, because one side in that high volume area is going to get stopped out. You just have to be able to identify when it's a side you want. So you have a push down and then the market pauses. Traders see that the market got overextended and they step back. It's like a wait and see moment. And you need this pause. You need to see an immediate reduction in volatility. So if the volatility does, if you get this big push down and the volatility doesn't reduce, even if it whips up and down, if the market stays very active, you have to stay out of the way. Okay? Just because it moves back up doesn't mean it's going to reverse. You need that pause, right? Now this will no doubt keep you out some good trades, because sometimes it just does immediately reverse. But the best trades are when the excitement fades away. Now we all know the market doesn't move in one direction, and we don't want to presume that every pullback is a reversal. So we need to see some kind of behavioral change, some kind of pause. Next, we want to have the traders at that tipping point, that high volume area. We want those guys stopped out. Now note that with a large volume at any price, you're going to have long and short positions there, which means in any area with a lot of volume, there's going to be stops above you and below you. So after a move down, you want to see buyers attempting to run those stops for a reversal back up. And that's something you could see either before you hit that area of high volume, as it trades at that area of high volume, or after it's moved through it. So you don't have to enter at the best price, right? You enter when you've got clear confirmation, when you've got real aggression, trying to drive those guys out of position. So for now, I would recommend with this kind of trade, forget about any concept you've got of kind of being too late to enter, right? It's all about confirmation. So if you see aggressive buying, you stick with the trade until either you get through that area of high volume, okay, or the aggressive trading stops and the market starts to tip back against you, or you get the stop run. You can relax a bit then. So this pop is the first sign that your trade is going to plan. It's a rapid move your way when the traders at that tipping point get stopped out. Now, you could even enter after the market's popped, because that pop often signals the start of a little pullback. So the pop occurs when traders get stopped out, and that's the key, because sellers so far on a move down, sellers have had it all their way on the way down, okay? And then we go through an area of high volume, and now we have sellers getting stopped out. And so sellers probably not going to be so keen to sell again straight away. It's also when other traders that might not be engaged in the market yet might not be positioned, they're going to start to see potential in the upside. So it's just helping to tip the balance to your side. Now, if you scale out of trades as I do, then the pop should be where you try and get your first target, where you first try and take profit. So even if there's no continuation after the pop, you took some money off the table. Now, of course, sometimes there's no pop at all, and when there's no pop, it just means it's less clear to everybody, right? Perhaps the traders didn't get stopped out. Maybe they aren't bothered if it moves against them a little bit for whatever reason. Maybe they're not so shy about selling again. If there's no pop, but the market just kind of gradually drifts upwards, you can get in, but you have to be very wary that aggressive selling can come in again as they take advantage of those higher pricing, and that aggressive selling could move the market swiftly down. So as I said, the pop is often continued by the market taking a breather. So it's a good idea to take some profits when the market does pop. And if the market continues after the prop, then you've got a really good chance of it being an extended move. But just be aware, it's not always the case. Okay? Sometimes, as in this case, the market pops, the market pops, but then it just goes sideways. So you can see you've got a collection of high volume here, and then you can see, boom, this aggressive move up, and then you've got the pause, but it just moves sideways. Now you've got a choice as to how you can handle this scenario, right? So you could stay in this trade and see which way the market ends up, right? In my experience, though, the actual most likely scenario at this point is a continuation downwards, right? So what you want to see is you want to see this pop. It's fine for the market to come back a bit, but then you do need to see buyers come in and actually start taking the market up. So for me, if I'd been in this trade, well, sorry, for me it was in this trade. So for me, looking at this trade, my expectation, if we'd had that little pullback and a move back upwards, my expectation, as you can see from here, would have been to get to 58.44, kind of the start of that leg down. Excuse me, just let me have a drink of water. Okay, I'm gonna go through your questions. Let me just go through some of the questions now, because it's probably easy to explain on the chart. Right. First question: how is the more net short positions if there is a buyer for every seller? Well, that's exactly right. So the way this works is every market order is matched with a limit order, but the market orders consume the limit orders, right? So a sell market order gets matched with a buy market order, and as the sell market orders come in, they eat the buy market orders, and the market moves down. So the aggressors are the sellers in that case. Okay, and those aggressive sellers are the short-term guys that are going to be stopped out. So you're absolutely right. Every buy is a sell, but the markets can still become imbalanced, right? Second question: what is excessive volume, right? Excessive volume is when you trade a lot of volume at a particular price, right? At a particular time. So, like in this instance here, we can actually see on the volume profile here, we've got 2,882 trades, 3,863, 3,391, 3,313. And that's going to be a mix of buyers and sellers. Okay, excuse me, I've got a little bit of flu here. So that's going to be a mix of buyers and sellers. So you've got this whole bunch of volume here and here. And as we move up, the sellers, you can see this is mostly red. So mostly that was sell market orders on the way down. As we move up, those late sellers are going to stop out, right? So that's excessive volume at a particular price. Now, somebody else is asking, what's the time frame? I will stop answering questions in a second just to get through to the end. What's the time frame? So this is a really short-term compressed chart. This is actually a 10-second interval, right? So we're literally looking at a volume spike here that from here, this is only like 8 minutes time, right? So we're looking at very short-term activity, but that can yield quite a significant number of ticks. Would people be able to look at the recent drop in the ES and subsequent recovery? I haven't got my platform open at the moment. I tend to keep it turned off when I'm on a webinar because of the bandwidth. I'll go through the other questions shortly. Okay, so anyway, what we've got the volume, we've got the pop, and then we've got no continuation in this case. That's one scenario you have to look out for, and one of the reasons you try and benefit from the initial pop. Now, you might find that you just decide to trade a larger position with one target just to benefit from the pop, right? There's lots and lots of ways to do this. Now, there is one other scenario to look at. So you've obviously got the scenario where it pops and continues. You've got the scenario where it pops and moves sideways. Obviously, you've got the scenario when it doesn't pop. And then you've got the scenario where the pop is just a little bit too good. Now, in this case, what I've got two charts here. I know it's a bit difficult to read, but you can see the white line separating them. This is the earlier chart, right? So what we had, initially, we had a spike to the downside, which was traded as a long. And then the pop up, you know, we can see the excessive volume here, and then we can see the pop up in itself was somewhat of an overreaction, right? So we can see this pop down here and the volume here, but the pop up here, that was kind of an overreaction. That was way more volume than just these guys getting stopped out. So the pop up was somewhat of an overreaction, and that leaves you to make a decision. So do you now reverse at this point and take a trade to the short side, or do you hold for continuation upwards? And for me, in my opinion, is when the market pops up a lot like this, and it pops up kind of too much. This was 18 ticks in, I don't know, 30, probably, well, that was actually one 10-second bar, right? So if you count this, probably, you know, 30, 40 seconds, right? I presume the market's gone too far in the other direction if that happens. So I'm quite happy to play it back the other way. Now with this trade, unfortunately, one of the other factors was against us, and obviously with all trades it's the same thing, right? This is 8:59 Eastern time. I'm 12 hours ahead, which is just before the 9 a.m. It's the old official pit open of crude, which is still where a lot more players come into the market, even if it's not really the open anymore. And at that point, a lot more volume comes into the market, just like when a news announcement comes in. Market's going to change characteristics. So, you know, if you get in a trade that close to the open, you need some clearance away from your entry price before the open, because once a lot more volume comes into the market, right, this volume here kind of becomes irrelevant. You know, so if you think, you know, you're basing off this volume getting stopped out, but if you get like 10 times the volume coming in at 9 a.m., and I'm not sure what the exact ratio is, that amount of volume becomes irrelevant, and there's not really, even if they stop out, it's not going to have any impact on the market, right? So keep an eye on 9 a.m. Eastern. Keep an eye on the, you know, the old pitch session opens for your commodities, because there is a change in behavior there. And obviously keep an eye on news announcements that impact the crude market, because they're going to cause a market reaction. Those trades, you know, at this tipping point might just become irrelevant when a lot of new traders come into the market. So, summarize, right? This trade is not about being right all the time. It's about having a good risk-reward ratio. Each market does act a little differently, so you've got to make sure you focus on one market initially and get to know that really well. So, for instance, the DAX has lots and lots of spikes, but you've got to be really fast in catching them, right? Crude, gold are a lot more tame, less opportunities, but easier trades. So before you actually get into this, get to know how the spikes operate on your market. And what I'm talking about is at least a couple of weeks where you sit down and write down, you know, how it behaved, and you just get used to watching them, right? They do occur multiple times per hour on some markets, that's sometimes a day. So you know when they occur, time of day, market conditions, failure rates at those times of day, all that kind of thing. Now, don't worry, as I said before, about knowing ahead of time where a spike might appear. Now, I would say quite confidently, it's not going to help. It's not going to help doing any pre-market analysis for this stuff, right? You've just got to do your analysis over time on that market to figure out how it actually plays out. Now, I'd also say this is one of those trades where you should look at a 3 strikes and you're out policy. If you keep fading spikes on a one-way day because conditions are different, I mean, crude, we had a big rundown in crude yesterday, and if you've been fading all those spikes, you'd have got into trouble, right? If you're doing that because either the conditions are wrong, you're reading it wrong, whatever, right? There's no point sticking with the trade, right? You shouldn't do it because you shouldn't be getting in, you know, when the market's that frantic, right? So 3 losers, especially 3 consecutive losers, should be enough to tell you it's not going to happen today. Now I'll just click to the next slide and I'll just review the questions. Right. Where are my initial stops? I don't have, right, people don't know this. I don't really have initial stops. So I'm getting in mostly because I see aggressive buying. Now, as I said, if you've got a lot of buyers hitting the offers, market's not going to tick back. So I've already seen it kind of stop and kind of, so it's done the big move down. I've already seen it stop. I'm seeing aggressive buyers come in. So it's already slowed down. As long as those aggressive buyers are in, are there, and we're not back ticking against them, I'm kind of okay for that. You know, I don't really have a hard stop. The stop is really based on the behavior. Do I provide a template and a chart with my method? The platform you've seen is just it's a standard Jigsaw day trader platform with standard settings. So that's the way it comes out of the box, Jean. Now, would you say the stop should be the low? Now, the stop should absolutely not be the low. You should never have your stops at the low. You've got to look at getting stopped out above the low, right? So you've got to get out of the trade before it's the low. Once it hits the low or goes through the low, people are going to get stopped out. Market's going to really run, right? There's no point sitting through that. Michael said you could almost trade the pullback. Absolutely, you could watch for the pop. Wait for the pullback and trade that, right? It's just their observation. That's not what I did. There's no reason for it. I don't take it. Well, Pablo, do I take in consideration where the liquidity is? Well, the liquidity was where the high volume area is, right? So if you look at it, the only way high volume could have traded there was because there was a lot of liquidity there, right? Because the market stopped and traded a lot. But really, on the market depth, it wasn't visible. They just kind of layered into that in an iceberg as they traded it. So I wouldn't look for the depth ahead of time. This works. Actually, this works decently in the Asian session and London session. So you just got to pick your market. But yeah, it is a decent trade. Obviously, at slower times you get less of them. I don't enter. Davies asking, do I enter when the excessive volume displays? No, I absolutely wait for confirmation, right? I absolutely wait for confirmation that they're trying to run it, right? If you just see the volume trade, you're going to get, so you see the volume trade, market pauses, and then you look for the run. What do institutions endure before they puke? That's a really big question, because I know traders who trade for a tick, and they won't. And a lot of the time they're actually getting out because the trades are hitting their price, so they've got almost like a zero tick stop. But I don't think there's any definitive answer to that. Your stop's always related to how you trade. Let me just go through to the last slide, and then we'll see if we can go to the questions, because obviously many of you are going to be wondering maybe how to identify the aggressive traders, maybe you're not sure how to write your plan. A lot of questions might raise up. And what we like to do for people who've got these questions, and you're interested in this kind of thing, the next steps for you really depend on where you are now with your trading, because everybody is different, and there's really no cookie cutter, one size fits all approach. So what we prefer to do is give people a program that kind of suits them based on where they are today, so they don't waste a lot of time on things that really aren't going to make any difference to them. So our offer today is, we're not going to ask you to make a huge commitment, and to be honest, I'm not even sure why I charge $1 for this. I just think it's quite amusing to do so. Our offer is simple. If you commit $1, we'll spend 20 minutes on a live one-on-one call with you, where we'll discuss your trading experience so far and give you an honest assessment of whether we think we can be of any help. And we can't help everybody, so this isn't for everybody. At the end of that call, we'll provide you with a personalized plan for moving forward with your trading step by step, in a way that you can see progress every week. Now, we recommend that if you do sign up for this, you should record the call, because it's usually packed with information. So even if we don't end up working together, you'll most likely come away some pointers for making progress on your own. I like to try and get about 10 of these done a week. Not because I'm not trying to make them a rare commodity here. It's like I actually trade, and there are only so many hours in the day, so I can do a couple of these a day. The 20-minute calls usually take 40 minutes. So if you sign up right now, you'll end up getting to the front of the queue. So let me get back to the questions. Links there, jigsawtrading.com/review. How do X get the Kim Nuke fade? I think I was asleep when that rocket dropped in Japan. Are there any markets during UK evenings that are conducive to this type of trade? Jamie, give me if you can Skype me on Jigsaw Trading tomorrow. Let's have a chat about that, because of my brain's fried. I can't even think of the time zones. Do I think behaviour of the ES has permanently changed? No, Phil. If there's one constant in the market is change. It'll be volatile again. It's just going through a period of low volatility. Who would have thought, Donald Trump being president, we would have actually seen a less volatile market? Love him or hate him, I was kind of expecting him to bring more volatility. Is this for new traders? Well, it depends what you mean by new. I know people who have been trading for 5 years and haven't got a clue. It's just a trade that if you apply yourself to it, there's no reason we can't make it work. All you have to do is basically watch it a lot, at least for a few weeks. This is a high frequency trade. You don't have to watch it for 6 months, right? If you can pick a couple of hours on crude, if you can, like 9 a.m., maybe 8 a.m. to 10 a.m. Eastern on crude, and just watch all these spikes and make some notes about every one, you should be formulating a plan within a couple of weeks. You should have seen enough action for a couple of weeks. Is the consultancy for new traders? It is generally for new traders, but Michael, if you just hit me up on Skype, you know my Skype ID. And that got us to the end of the questions. Oh no, it didn't. When will day trader work with data feeds? OEC Trader. I'm just going through the compliance process now. Oh no, it's a big old spreadsheet. I thought we'd get it done today, but I'm looking at it and it's just like, wow, it's going to take a couple of days. So it's all done. It's all ready. We have a compliance spreadsheet to do with OEC to make sure they're happy with it. So I guess that the start of next week are going to beta. So with that, I've finished a little bit early. That means you've all got a chance for a toilet break. and a little rest. And if you want to get in touch with me, please feel free to do so. My Skype ID is Jigsaw Trading, and you can also get in touch with this link to join the review. So thank you all, and can I hand back now?